Well, and that, I guess, brings us to the question of the day, Danny, which is how much is Russia actually dictating what is going on with risk assets? So let's get right to that. We have some great correspondents here from Bloomberg to join us for that.
We do. We have Bloomberg's market editor Kristine Aquino and Bloomberg Markets Close anchor Romaine Bostic. Thank you both for joining us. Kristine, let me start with you. You're in, right next to me, so I'm going to put you up first here. I mean, how much does the stock market rally depend on some easing of tensions between Russia and Ukraine?
Well, Danny, I think it's definitely going to be helpful. We see these tensions de-escalate, of course, but what started as not such a great year for stocks already really just made a lot more worse by the fact that we now have to factor in geopolitics, in addition to some of these longer-term catalysts for equities that we've seen thus far this year, which is, of course, the move toward tightening among big central banks, and also kind of the decoupling of some of the big themes such as tech outperformance and the shift from growth, the potential shift from growth to value, and all of these themes. And just add geopolitics to this, and certainly a lot more two-way risk than perhaps investors were bargaining for at the start of 2022.
Well, and looking at the risk relief rally, potentially, Romaine, it's losing a lot of steam. We're now essentially flat on the NASDAQ 100, the S&P only up a tenth. So maybe there's not that much relief out there. Yeah,
not much relief here. I mean, we talk about sort of where that bottom is. That's what everybody's really looking for here. You look at some of the performance or the underperformance of a lot of those tech stocks. It was interesting. There was a barrage of commentary out by a lot of the strategists here in the U.S., including over at Goldman Sachs, which talked about that tilt away from tech into value. There was a competing note out by the folks over at Morgan Stanley that said, well, maybe that's a contrarian signal. Maybe that's a sign here that we've gone maybe a little bit too far below where we would normally weight a lot of these companies, and that might be a buying opportunity. But when you look at the price action today, you get a sense that there's not a whole lot of conviction to that just yet.
Romaine, this is one of the head scratchers for me, that all of a sudden you wanted to make a bet on tech, and now you're having to think about Putin, what's happening on the border, two things that certainly analysts are not really prepared for. When you look at what people are saying about big tech, do they assume that the link between these two will start to dissipate?
The link is sort of tenuous at best. I think where the link is the idea, kind of what you just said. You said certainly, and that's the problem right now. There is no real certainty. We're coming off of a bull market where you could have pretty much thrown a dart at the board, hit whatever you wanted, and you were going to make money off of it. We're now in this phase here where everyone's concerned about inflation. Everyone's concerned about what the Fed may or may not do, how that's being priced in, and now the geopolitical ripple effects of what's going on with Russia and Ukraine. Maybe there isn't a direct one-to-one correlation between the stocks here in the U.S. and what's going on over there in Russia and Ukraine, but the ripple effects from a disruption in commodity exports, a ripple effect here in the ability of Russia to sell new bonds into market, the ripple effects of U.S. investors, I guess, to continue investing in some of those Eastern European assets. That's where I think where you have to look. The chart on your screen right now, it shows you that some investors are betting that the Fed may actually be a little bit more cautious, may a little bit more, I guess, slow the pace a little bit versus what we've the communication that we had got on them before. We're talking like 35 basis points being priced in to that March meeting. We were up at about 40 basis points just a couple of weeks ago. So some people are tempering their expectations.
Well, Kristine, talking about what's being priced into the bond market, the flatter curve persists yet again today. The 2-year break-even yield at a record high. I mean, what is this market signaling about inflation expectations?
Well, Kaylee, I think they're definitely running away. And it was really interesting, to Romaine's point, this was definitely a question yesterday when markets were still trying to digest what's been happening in Russia and the Ukraine in real time. And I think initially there was the assumption that, the rise of geopolitical tensions means that the Fed, it can't hike as much as it probably wanted to in March, and same for other central banks. But then a few hours later, I think this discussion of potentially oil hitting $100 per barrel suddenly hitting markets, and everyone realizing, hang on a second, this is actually an inflationary risk, and so those rate hike bets very much back on the table.
Is that the same for the ECB, though? And Romaine, you jump in here.
I just wanted to Kristine's point before you move away from Kristine. The point about inflationary pressures is big, because we talked to a couple strategists who said this, that's really the real risk, at least here in the U.S. It's more about, do these geopolitical issues add to the inflationary pressures that we've already been feeling? If that does materialize, then you could see a further sell-off. If that doesn't materialize, then maybe the bottom gets called.
I have to go back to this point, Kristine, though, that Kayleigh brought up of signs of economic weakness, especially in Europe. Does the same hold true for the ECB when you look at, for example, of European debt spreads start to widen?
Yeah, very interesting question, Danny, and something that we're definitely watching out for, because as you mentioned, you know, signs of economic weakness, definitely the price of energy very much factoring into that. And the question of, is Europe going to be able to afford energy prices if it does skyrocket, especially given that we are already facing an energy crisis in Europe. And so if you add these kind of added geopolitical risks and tensions to the equation, definitely one for the ECB. It's going to be difficult for them to navigate, but they're going to have to in their next meeting in March.
Kristine, what's going on with havens? We've seen a weaker Japanese yen, for example, for the last 2 days. I mean, where's the hedge? Where's the haven bid?
Well, Kayleigh, yeah, I think there's been a bit of a debate, actually, in terms of what would be the haven of choice at the moment. Again, you know, the Japanese yen and the Swiss franc probably in the top spot, battling it out. The dollar probably coming in a little bit of a distant third, just because there's definitely this sense that, oh, the dollar's windfall from a tighter Fed policy and higher yields is fading a little bit. But then it's a question of, you know, accessibility, liquidity, of course. The dollar is a lot more liquid than either the Japanese yen or the Swiss franc, and so it's just a question of access and which regions are more exposed to each currency at this point.
Let me take that idea, Romaine, and move it into the stock market. When you look at what's being hit, what's not being hit, where are sort of the ports in the storm as geopolitical tensions ramp up?
Well, it's really two areas. Obviously, you're seeing a lot of ructions with regards to energy stocks or stocks tied to the energy sector, and really the commodity space. And I think it's important, too, that we kind of broaden out this discussion when we talk about the commodity ripple effects. It's not just oil and gas. It's, of course, a lot of precious metals, a lot of industrial metals, and, of course, even a lot of soft commodities like wheat, corn, safflower oil, things that are huge export markets coming out of not just Russia, but, of course, Ukraine and that whole Black Sea region. So you're seeing a lot of those companies affected. But it's really about evaluation here, I think, Danny. When you talk about what was being priced into this market before these incidents occurred there in the Ukraine, it was really about were some of these names overvalued in the face of a rising interest rate environment, and now you add in the geopolitical tensions, and those valuations get called further into question.
Romaine, you told us a few weeks ago we should be trusting the technicals. What are the technicals signaling here? Well, the technicals aren't telling you that there's a bottom. Unfortunately, that's just the case right now. You continue to see weakness below all of the key moving averages. You pick whatever technical measure. There's so many esoteric names out there, but they're all pretty much telling you the same thing. This market has not rolled over. It just hasn't.